Welcome to Dad Gives Advice. My name is Orestes, and in this video I'll be talking about the multifaceted world of real estate investing. Real estate has long been a target asset class for investors seeking diversification and the potential for long-term capital appreciation as well as income. But there are some important downsides that should be considered as well. Before I begin, I'll remind everyone that the information in these videos is for informational and educational purposes only. Anything I say should not be considered individualized advice, and you should always consult your personal financial advisor before making any investment decisions. Real estate investment usually involves the acquiring, managing, and maintaining of real properties, with the goal of generating rental income and potential capital appreciation over time. This investment approach can take several forms, from the direct ownership of homes, apartment buildings, or other rental properties, to investing in securities such as real estate investment trusts and mutual funds that hold real estate interests. Direct ownership of properties allows investors to have more control over their individual investments and may come with some tax advantages, while owning securities like REITs and real estate mutual funds gives investors exposure to the real estate market without having all the responsibilities of direct ownership. Real estate offers some unique advantages to investors. One of these is the potential for a steady income stream. Additionally, real estate properties have the potential for long-term capital appreciation. If you buy a real estate investment today for $100,000, say, in a few years it might be worth $125,000 or $150,000, depending how the market is in the area where it was acquired. This is not guaranteed. In some places, real estate remains flat over time and may actually go down in value if there are issues in that market, like people leaving to go to other real estate markets where things are growing and where jobs are more abundant. Real estate investors can benefit from various tax advantages. Deductible expenses such as property taxes, mortgage interest, and maintenance costs can help reduce the overall tax burden. Moreover, depreciation allows investors to write off a portion of the value of the real estate property from their taxes every year. Another notable aspect of real estate investment is the ability to use leverage. By financing a property with a mortgage rather than paying it in cash, an investor can control a more substantial asset with a smaller initial cash investment. This leverage can amplify returns since the initial cash outflow is lower than if you were to pay for the property entirely in cash upfront. But it also adds to the risk if property values decline over time. While real estate can be a valuable investment, it's essential to recognize what the potential risks are. Market fluctuations, changes in interest rates, and economic downturns can have a negative impact on the value of your real estate property. Additionally, being a landlord comes with more responsibilities and potential challenges, such as tenant management and property maintenance. When something breaks inside or on the property, you as the owner are responsible for all repairs and replacements. That can sometimes be very costly and cut deeply into your bottom line. Consider having to replace a roof on a property you bought a couple of years ago. That could be tens of thousands of dollars or even $50,000 or more, depending on the size of the roof and where the property is located. When considering real estate as part of your investment strategy, it can offer a degree of diversification since it is not well correlated with other financial assets like stocks and bonds. However, real estate is less liquid than stocks and bonds, and it may take a while for you to get your cash out if you were to need it in an emergency. In such an emergency, you may have to sell low in order to get your money out, and this could result in a potential capital loss. Contrast this with mutual funds where you could get the money out much more quickly. Furthermore, when it comes to diversification, consider that an investor's main home is usually a very large portion of their overall net worth. So if you don't have a sizable enough investment portfolio, you may already have enough in real estate in your own main home, and separate real estate investments may not be for you. Real estate investment requires time and effort. Managing properties, handling tenants, and staying on top of maintenance can be very demanding. Investors should be able to commit to the responsibilities related with real estate investment before jumping in, and realize that this could be somewhere between a part-time and a full-time job, depending on the number of properties that you own. You may also have to deal with the additional risk of a tenant who is not able to pay rent for several months before you can evict them, all while still having to pay mortgage payments to the bank yourself. All this is to say that there's a lot of moving parts and angles to look at when doing real estate investment, and you should do a lot of due diligence before jumping in and buying your first property if that's the way you want to go. Because this area is full of so many issues and potential pitfalls, this is why I decided to move away from direct property ownership and rather included real estate investment trusts and real estate mutual funds in my portfolio in order to diversify and have some exposure to real estate without having to have all the management headaches and all the maintenance headaches that come along with it. These real estate funds still come with risk. There's no such thing as a no-risk investment, but they are easier to deal with than with direct ownership of properties, and they're also easier to balance in and out of should you have to do so in order to maintain your overall portfolio balanced. Bottom line is that if you're a very small investor just starting out, then you should probably just stick to stock index funds and not worry about real estate investments or real estate mutual funds until you have acquired a larger portfolio and you're ready to move into that kind of asset class in order to further diversify. Investors with larger portfolios may benefit from some diversification into real estate using these kinds of mutual funds or REIT funds. As an example, someone with a $500,000 portfolio may want to put about 5% of that into real estate funds in order to gain that exposure to that asset class. But again, each investor is different, and you should always seek the personalized advice of a financial advisor before taking any action. Remember, like any investment, real estate should be approached with careful consideration and with a long-term perspective. Always consult with a financial advisor to see how real estate aligns with your personal goals and plans. If you have any questions about real estate investment or investing in real estate funds, or if you'd like to see me cover some other topic, leave a comment in the comments below. Other than that, thanks for watching and have a great day.